US President Donald Trump has announced that the interim agreement with Iran aimed at ending the conflict is officially over. The decision has reignited geopolitical tensions and sent shockwaves across global financial markets. The agreement, brokered by Pakistan, included a temporary ceasefire, negotiations over Iran's nuclear program, and plans to reopen the Strait of Hormuz, one of the world's most important oil shipping routes. However, according to Trump, the negotiations failed to produce meaningful progress. As a result, the United States resumed military strikes against Iranian targets and revoked temporary waivers that had allowed Iran to continue exporting oil. The announcement immediately triggered a strong market reaction. Oil prices surged as investors grew concerned that renewed conflict could disrupt energy supplies from the Middle East. Higher oil prices also fueled fears that global inflation could rise again. Meanwhile, global equity markets weakened as investors moved away from risk assets. At the same time, the US dollar strengthened as demand increased for safe and liquid assets. So, what about gold? Under normal circumstances, rising geopolitical tensions tend to boost gold prices because the precious metal is considered a safe haven asset. This time, however, the story is more complicated. The surge in oil prices has raised concerns that inflation could remain elevated, leading investors to expect the Federal Reserve to keep interest rates higher for longer. A stronger US dollar and higher Treasury yields have offset gold's safe haven appeal, limiting its upside despite escalating geopolitical risks. In short, gold is currently being pulled in two different directions. On one side, geopolitical uncertainty is supporting demand for safe haven assets. On the other, expectations of prolonged higher interest rates and a stronger US dollar continue to weigh on prices. That is why gold's gains remain limited, even as tensions in the Middle East intensify.